Dan, great to have you with us. I first of all want to get your take on where yields are right now. Do you see them going higher? Do you see them going lower? Back in April, you saw negative yields, but there was pretty lackluster demand on the 10-year auction today.
All right, to be clear, I was afraid of negative yields. I was in a panic about it. The Fed's been pretty clear they don't want negative yields. We'll find out tomorrow. They are heavily influenced by yields elsewhere in the world. And these yields have been negative for some time in Europe, and the base rate, which is essentially German government. And the Fed is afraid of that because their very first mission is to keep the banking system running. And if you get into a negative yield situation, it's very, very hard on all the banks, but particularly the small and smaller medium-sized banks. So they're very concerned about that. Then they also want to fight inflation and promote employment. But that's a big, big, big concern for them. So I doubt very much if we're going to head towards negative, or if we're going to arrive at negative yields.
So even if we don't arrive there, Dan, I mean, there is a general sentiment in markets that we are going to remain near zero, or at least, below 1% on the benchmark 10-year for a short period of time, if not necessarily a longer period. If you are in the market, in the equity markets right now, and you've seen the gains that we've had going back to March, and you're looking for a way to hedge going forward, can you still hedge in the Treasury market?
$64 question. I've done a little of that at the long end. It scares me. It's not a good way to get a good night's sleep. But I think you can, and I think you'll be able to for a while. And the market is liquid. Depending on your size, you're probably okay. And I wouldn't overly worry about it. But that's really all I can say on that. I do think that these lower rates than history are going to be with us for some time. I was a little surprised, quite frankly, by the backup in the long end that we had as the curve steepened here in the last handful of days. But let's face it, the market is big, liquid, and so forth, so the Fed doesn't have to worry about that aspect of things. They do keep an eye on what the other major central banks are doing. And as I said, Europe's negative, Japan's next to it. So there is an attraction towards the U.S. Pay instruments and towards treasuries. I sort of count on that to support the short and intermediate range. The long end, you can't be quite so sure.
Dan, I'm interested by also your take about, previously you were saying you were getting worried about the potential of negative rates in the US when it comes to sovereign bonds. What about the world of corporate bonds right now? It's fascinating that we've seen such ferocious supply coming to the market at the moment. It feels as though every syndicate manager out there is going and telling companies, come now or don't come at all. Do you think now is the time to be buying corporate bonds at all? Will that demand dry up at some point?
Well, let me put the answer in two parts. Number one, when asked, which I have been, what I would do if I were raising money for a fairly profitable corporation, I said I'd come to market right now and I'd borrow as long as I could. And I would try to get away with 10-year non-refundable or better than that, because there is a heavy demand. And that money's cheap, depending on your credit rating, of course, and the size of the company. But for a sizable BB plus type credit, the money's very, very cheap from a longer-term view, and I'd go get it if your long-term plans justify that. So that's my answer there. It's cheap, and I'd I'd do it. Now, how long this goes on, I just really don't know. I don't know. I would guess over a year and a half maybe. But markets have a nasty way of surprising you, or at least surprising me. And as you look forward, you have to keep in mind that other people are looking even further forward. And there's a ton of money looking to invest. Now, we had a period right at the end of March, early April, where you were better off buying the common stock of some of the stronger credits, Pfizer, Merck, things like that, than you were the bonds. And I actually went so far as to suggest changing guidelines on some of our bond accounts to the clients. And we, were able to do some of that. That was a unique time in recent year history. So that we'll see. We'll
Dan,
see how it goes.
Yeah, Dan. So, Dan, I mean, you talk about looking forward here. I mean, obviously, you have the benefit of being able to look back on the decades in which you've been in this business. You've worked through several bull markets, several bear. I actually went back to try to count, actually. I looked at when you started, and I tried to go back and count the number of bull markets and bear markets that you've worked through, and I lost track, Dan. But I'm wondering that when you look back at all of those various market cycles we've been through, is there something that you can draw on from any one of those past cycles that maybe gives us a little bit more insight, a better insight into how this current one may end or begin?
Well, thanks for putting my age so gently there. I have seen a lot of cycles. I've seen a lot of markets, and not all bad markets are necessarily coincident with cycles. The absolute worst market, by far, bar none, was 1974. Now, it was a period that ran just approximately 9 months and a few days, and it was god-awful. People remember it for stocks, but if you were in corporate bonds at that time, it was just awful. Each market is somewhat different. The one constant that you have to look out for in the markets that is not a worry this time is that money withdraws from the market because it's tight, because the Fed is leaning against it. 81 would be the best example. Or out of fear. Now, in this market, you've got something else going on, though. As you look forward, and this, I think, is, if you can solve this, you can forget about the market overall. The question is, how about the issuers of the debt? Will the Treasury pay its debt? Yeah. What about the agencies? Yes. What about corporates? And what about major munis, states? I'm working on the assumption that we will probably not have a major default, a default of any kind, by one of the 50 states. That could be wrong. Now, if that happens, then you've got a different situation. But I do anticipate a very difficult time on the corporate credit side for many issuers. And as this starts to play out on their earnings, you're going to have a widening of spreads. And that's and a change in tax policy will do the same thing.